Dear investor, Edelweiss Private Wealth Management is pleased to present you the latest issue of Investment Strategy Report for June 2019. Let's take a look at key highlights of May 2019. Post-elections, BJP emerged as the single largest party consecutively for the second time. According to market expectations, an empowered government with absolute majority is likely to drive a number of reforms in land, labour and direct taxes over the period of next 5 years. Financial year 20 has begun with very strong FII inflows in equities. The FIIs have shown confidence in Indian markets by investing in excess of Rs 29,000 crore in just 2 months of April and May, YoY an outflow of Rs 88 crore in financial year 19. US-China trade war stole the global headline in the previous month, with US raising the tariff from 10% to 25% on $25 billion of US imports from China. China's economy showed signs of slowdown, with slowest growth in retail sales since 2003. Industrial production in the United States fell in April, dropping 0.5% from March to April and rising only 0.9% from a year earlier. For the 9th time in the last 12 months, industrial production in the 19-member Eurozone declined from the preceding month. It fell by 0.6% year-on-year in April 2019. On the other hand, consumer price inflation in the Eurozone accelerated in April. Prices were up 1.7% in April versus a year earlier. Decline in quantum of provisioning and smooth resolutions under IBC would spur the earnings recovery in public sector banks. At overall level, PSBs are expected to post a PAT of Rs 40,000 crore, YoY an estimated loss of Rs 60,000 crore at the end of financial year 19. Production in core industries like cement, coal and steel showed promising growth in the previous financial year. We believe post-election rebound in demand should lead to revival in orders and increased possibility of capacity expansions. Expected reining in of the fiscal deficit and easier monetary policy should attract sustained FII flows going ahead. They would be aided by the increasingly dovish stance of major central banks like US Fed, ECB, BOJ and PBOC. Past 3 occasions show that mid-caps tend to perform well in the 1 year after the election's results are announced. Since mid-caps continue to trade near bottom levels of valuation cycle, we believe they would again outperform the large caps in the coming year. Reduced emphasis on populism along with improved GST collections, special dividend from RBI and a rise in nominal GDP would be the major contributors for government to be on the trajectory of long-term FRBM target of 3% fiscal deficit. In the current year, RBI is likely to infuse more than Rs 2 trillion of liquidity through OMOs and dollar swaps, out of which Rs 60,000 crore have been already infused via USD INR swap of $5 billion and OMO of Rs 25,000 crore. A second tranche of OMO of Rs 15,000 crore is scheduled on 13th June 2019. Government may also receive a special dividend from RBI to the tune of Rs 100,000 crore, which will ease out liquidity situation even further. Comfortable liquidity will aid in efficient transmission of interest rate cuts. Corporate bond spreads have come down by around 20 to 30 basis points in the last 3 months, indicating comparatively easier and cheaper borrowing conditions for corporates. However, when compared to their respective long-term averages, they are still attractive for investors from hold to maturity perspective. We recommend investors to focus on hold to maturity solutions to lock in currently available attractive yields in corporate bonds and STLs. Clients with allocation to duration should continue to hold to benefit from likely fall in the interest rates.